Portland, Oregon, and we're going to be talking about a potential deal that his client might be looking at. He's going to ask some questions, but I'm going to record this so you, the listener, can learn and glean some wisdom. So Daniel, tell me a little bit more about what your client is facing, and maybe ask any questions that you might have right now.
Yeah. So the biggest deal right now that we're working on is actually an engineering firm that my client owns one third share. It's structured as an S corporation. And so he is hoping to sell it this year. They said they already have some buyers that are taking a very serious look at it. And it's about $4 million with very little basis that he would come away with. So the whole sale is closer to 12 to 15.
Okay. So
Um,
the
so
wholesale is closer to 12 or 15 million,
yeah,
and he's going to come, and his portion is about 4 million.
yeah.
Got it. And then is it a S corp, C corp, LLC?
Yeah, it's structured as an S
Okay.
corp. Yeah.
It's very simple. How many partners are in the deal?
I think there's five total right now. Yeah.
Okay, five total. So he's one of five. And why are they selling? I'm curious.
They're all the partners are getting to retirement and they're in their 60s. They're just wanting to enjoy life.
Got it. And do they have any debt on the business?
No.
Okay, that's cool. And then their adjusted basis. Most of these are usually zero, but
Mhm.
maybe there's a little bit. Do you know if their adjusted basis is zero?
I think it's pretty dang close. Yeah.
Yeah. So so typically we like to say 30 to 50% in capital gains tax and depreciation recapture, depending on the state, depending on the deal. But generally speaking, do you know what if they had their CPA look at what their tax liability might be? Do you know?
They're not quite sure yet.
Okay. Sometimes they don't even want to look at it because they're like, oh
Yeah.
my gosh. Like, but yeah, it's big enough, right? So let's just do rough numbers. Let's just say 30%. Okay. So let's say it sells for 15 million. 30% is $5 million, right?
Hmm.
So, and if you take a fourth of or a fifth of that, because is it equally owned? A fifth, five partners?
No, he owns a third of it actually.
Oh, he owns a
So
third.
yeah,
Okay,
there's like three main partners and he's one of them. And then there's like two others that are very, very small.
got it. Okay, so I'm gonna take basically 5 million,
Hmm.
about a third, right?
Yeah.
Um, is his portion, but also about a third of the tax liability, which we said was 5 million. So
Hmm.
33%. So it's about 1.65 million. So it's either like use the trust and have approximately 5 million minus some closing costs, or don't use the trust and have it 5 million minus 1.65. So yeah, he would definitely qualify because he'd have like 3.35 million. And what's this is substantial. So as a financial advisor, you can manage extra money, right? This is tax deferred. It's kind of like putting an IRA or 401k. He can slowly take payments and he'll pay a little bit of interest or pay ordinary income tax on interest. If he dips into principal, he'll pay a little bit of capital gains tax. But that's the general framework. So what questions do you have right now?
Yeah, actually, the biggest question I have is with the S Corp. I'm not an attorney or a CPA, but from what I understand, you can't just have a trust come in and take your shares. The other partners might be a little frustrated with that or something like that. Can you walk me through just the step by step there as far as is the trust getting gifted the shares? How does that look before actually selling the business?
It all depends, okay?
Yeah.
And this is the part where I'm like the nurse that checks you and your client in for surgery, right?
Yeah.
And basically, an X-ray will need to be done of the entity itself. An
Hmm.
X-ray will need to be done of the purchase and sale agreement or the asset purchase agreement, and then and this is all no cost, no obligation. They can kind of give the diagnosis A, and then B the treatment plan, right, or the surgery that needs to be done. But generally speaking, S corps are you have shares, right, and your ownership that can be what's called assigned, right, and it should not affect any of the other partners. So if the other partners want to just take their cash and pay their tax, no problem. Guess what? Once they learn about this, they might want to say, you know what, I might want to do this trust thing too for myself. Okay, well, okay, great. Then we can set up an individual trust for each partner, each family, right? They're not commingled, completely separate, and each of them could assign their shares to this newly formed entity, and the funds would then sell or would ultimately end up in the trust, and they would receive a promissory note, right? Because they're lending the funds to the trust. So the answer is I'm 99.9% would be no problem at all, not an issue with any of the other partners. And second, they could even do their own, and they could also be tax deferred.
Gotcha. Okay. Yeah, I wasn't sure how that looks from a legal standpoint as far as how the shares get into the trust first, because I know that needs to happen in some capacity before they actually sell the business, right?
So let's talk about timing of this. You're absolutely right,
Oh.
right? So do they have an offer on the table now?
They said that there's somebody that they're trying to get the valuations, like they've already gotten the valuation, so they're about ready, I guess.
Perfect. So the timing couldn't be better, right?
Yeah.
Ideally, we would set up, I like to say everyone do their exit plan now
Hmm.
versus exiting when you're like 2 weeks away from closing, when it's just you want to try to separate these two because it's emotional. Right? They've been doing this for 20, 30 years. This is their life savings. And all of a sudden they're faced with huge tax. But like an ounce of prevention can save a pound of pain, right? And
Hmm.
so by doing just prevention right now and setting it up, then we can get everything in order so that when things start to move, it all goes into the trust versus going to them and being taxed. Okay, so step one is we get on a no-cost consultation call with myself, you, and the client, and or other partners if they want to join. Step two is we answer any questions they have. We review their S corp, and how it's set up. And then step three would be they say, yeah, we'd like to consider this. They sign a conditional engagement agreement. We set the trust up, and then boom, it's all ready to go. They go into contract, and basically they ask the buyer to cooperate with these newly formed trusts. It's not unlike cooperating with a 1031 exchange or cooperating with a living trust or cooperating with some estate plan. It just happens to be a business trust known as a deferred sales trust. And the buyer gets everything they bargained for, which sometimes is a concern for the sellers. Like, oh, are they going to be concerned? Or no. They're actually really happy because if for some reason the business didn't perform the way that maybe you said it would, there's money to be able to pay them, right? Because he has not all paid in tax yet. So there's this whole idea of, oh, I think they're going to be, no, not concerned. It doesn't affect the buyer at all. They get everything they bargained for. But technically what happens is there's three parties. The asset is sold, or the shares of the S Corp would be assigned or sold to the trust first. And this scenario, let's imagine all the parties are doing it at 15 million, okay? Each of theirs would be assigned total of 15 million. Then the ultimate buyer would come in and buy it from the trust. So it's like a simultaneous close, but the trust will only buy it from your client if the other buyer is going to buy it from them. So for whatever reason, that buyer is not ready to perform. In other words, it's like an option. It's an option to exercise, right? And then it's like the simultaneous close. Tax attorneys takes care of all this with the M&A attorneys and maps it all out. So it's very, very clean. But the smoke clears. The buyer takes title the same way we would have. He has the business. The clients have a promissory note. They haven't taken any of the cash. The money is owed to them, and the trusts are all set up with you. In wherever you might be TD or Charles Schwab or Pershing, wherever you might
Schwab.
clear.
Yeah.
Yeah, and you set up the accounts, right? And in the name of the trust, and the funds get wired to you there at those accounts, right? Where you guys custodying it, and a risk tolerance questionnaire is filled out that you send to them. And they approve of the investments. Now, I also have to approve the investments. This is important. Remember, they don't own the trust. If they own it to be taxable, they have to have a third-party unrelated trustee, which is my role. I also can't be the financial advisor, right? So we're separated necessarily to make this happen. But we're all working as a team to keep, let's just say for your first client, 5 million all in there, right? And typically 6, 7, 8% is the goal over a 10-year period, net of your fee, Daniel, my fee, and my business partner's fees. That's the goal. Not a guarantee, not a promise, but it's a lot better than paying 1.65 million and it's gone forever, right? Does that make sense?
Right. Oh yeah, definitely. I love that. Yeah, I think the only thing I'm maybe just my gap in understanding, but the way that the assignment, you use the word assigned the shares to the trust, is that what's actually happening, or is there something deeper in that quick transition? I followed everything except for that little.
Yeah, and so what I'm saying, so remember, I'm from a nurse perspective. I'm not the brain surgeon, right? So it's a great question, and my business partner, who's the CPA tax attorney, he'll answer that. And
Okay.
and again, I can't even really. I'm just giving a high level because we haven't even done an X-ray of the S corp, right? So it's like saying, how are you going to fix that ACL? And you're like, well, what was it? The MCL, the ACL, the PCL? Like what? Well, I don't know. Well, let's go do that MRI. So we got to get the information from them. Let's do the MRI, the X-ray. Then he'll basically say, this is how we would map it out. Now, here's the cool thing. Thousands of closes, billions under management, orthodontists, optometrists, car dealerships, commercial real estate properties, cryptocurrency, primary homes, public stock, private stock, you name it, artwork, collectibles, helicopters. It's been done, right? S corps, LLCs, C corps, LPs, all of it. It works. It works. It works. It works. It works. But not every deal is the same. So it's not like cookie cutter, like, oh, we all just set up a LLC, right? That's really common. Oh, there's a Wyoming LLC, a little bit different. This is a particular business trust, but even more particular each of the deals, and that's part of why it's not as well known, and people don't know it because they don't know how to do it. And so my business partner, who's the one who created it, has faced the IRS, is brilliant, but this is also why we do no cost, no obligation. Like we'll literally do the X-rays, the MRIs of the deal. We'll map it all out, side-by-side comparison. They say yes or they say no. No problem. One way or the other. Hopefully they say yes so that we can all, not give all the money to the government.
Yeah, I'm there with you.
The government wins too, by the way, because they're going to get tax dollars as your client receives payment back. I'm going to pay taxes. You're going to pay taxes on the management of the money, and the money gets infused into the economy, right? Businesses, stocks, right? Which spurs economic growth, generally speaking, right? So that's the way where they say, a business owner may not sell if they have to pay $5 million of tax on 15. They might just say, oh, forget it. We'll just let the business run into the ground. We'll just bleed it dry. Instead, you get this new capital flowing in that wants to take it from 15 million to 70 million. These guys get to exit and retire, and the new, young, aggressive, whatever corporate company, is going to make all those tax revenue. So it's a win-win for everybody. And that's why people, when they don't, on first blush, they think, it might be too good to be true. No, it's actually not. It's actually probably the best winner for the IRS. Then it's the best for the client, and then it's the best for Daniel and Brett.
Yeah, no, that's awesome. And maybe it's in the brain surgery X-ray conversation, but working with real estate clients, I know enough about the installment sale that triggers the depreciation recapture, even though you get to defer capital gains. So is that structure going to help us defer even the depreciation? Because they have a lot of equipment.
Yeah, it all depends. Okay, it all depends. Okay, that's like the key answer with our team.
Yeah.
Depends on what type of depreciation. Depends on what structure we use. We have two. We have a DST 1.0 and a DST 2.0. Okay, and so we're doing a $55 million deal in Florida right now, and that exact question came up because they're an agricultural company. They have zero basis, zero debt, but they have about 18 million worth of equipment that they've done what's called Section 179 on, right? And they depreciate a lot of this, or all of it. And they're like, oh my gosh, like that's going to hit us. Not with DST 2.0, okay?
Oh, cool.
So it's not so the first DST 1.0 is based upon IRC 453, which is an installment sale, which is what you're referring to. DST 2.0 is not based upon that. It's something that's different. It's proprietary. You have to sign NDAs and everything else. But one of the biggest ones is the $125 million deal in San Diego that was audited, no problem, no change. But even at the DST 1.0, it's my understanding that as long as your mortgage is not above your basis, okay, so their debt is at zero, right, on this one, and their basis is at zero, then we can still defer the depreciation as long as it's not a certain type of depreciation, which sounds like it's equipment. It means it's probably that depreciation, which means we probably need to use DST 2.0. So again, this is all a part of the if-thens, if-then. So we've got to take the X-ray, the MRI, before we can do the surgery.
I love it. Do I have 5 more minutes or?
Yeah, you do. Yeah.
Oh, cool. Just from the advisor standpoint, if we kind of focus on some questions there, is the relationship with me and capital gains tax solutions, or do you guys have like an RIA that mine comes underneath as an umbrella, or is it literally my firm and I'm actually taking the fees out of the accounts like I do now, or how does that look?
Yep, absolutely. So your fees are your fees, right? You're going to charge what you're going to charge, right? Within reason. We don't want folks to but we never had that problem. People are always like, what is your fee schedule? Let's use that, right? Boom, simple, right? Cool. Generally speaking, we like to say all in with you and us, okay, on a recurring basis, about 2%. So if it's $1 million, it's about 20 grand on recurring fees per year. Generally speaking, depends on how and where the funds are invested, okay, and there's some special stuff there. That's where most of us fall into, Daniel, right? And so we can send over that fee schedule, but that would be including you, most likely. Like that, I'm being kind of I want to be conservative here, right? As the amounts get higher, right? We're able to go a little bit lower. And so it just depends on the deal. Okay. Depends on how and where the funds are. Okay. So, but yeah, you're doing everything yourself. You're not having to change your RIA. Now you do need to join as a member with my business partner, which they're the ones who, FINRA, SEC, securities license, have been through all of that. And so, you join as a strategic alliance of my company, but we're not the securities license folks. In fact, I used to have my Series 2263. I gave those up so that I can partner with financial advisors, and I'm not going to be a financial advisor, so I separated myself from that, right? So, but you will join as a member with them, just for the NDAs, the marketing material, the training, and making sure that you're basically complying and not giving away the DST secrets, if that makes sense. So.
Yeah, totally. Okay. But as far as the client, it would show up, for example, on my Schwab master account number, and
Yes.
everything else would be the same. And
Exactly.
okay,
Everything
cool.
else is the same there. Exactly right.
Great. And so that's huge, because that's what I was freaked out, is that my clients can actually technically be doing business with a different firm. So that helps clarify that. And then I'm assuming that to be the member, the training, marketing and stuff, there's probably a separate fee my firm's incurring to be a strategic partner.
I think it's like $90 one time for you guys and like $40 a month. And I don't get paid any of that. That's just for them. But you could also have you could have like business brokers or realtors join underneath you who potentially might have highly appreciated assets that want to bring them to you to help them win more listings and for you to manage the money. They don't get charged for that, but because you guys have more red tape and he has to have more expense, he does like a break-even analysis and he goes, look, this is what it costs to do that. And with our training, does that make sense?
Yeah, totally.
Yeah.
Yeah, that doesn't sound that bad.
It's not bad. Like you do a $5 million deal, right? And you help a guy manage 1.6 more million. Yeah.
Yeah.
It's peanuts. It's peanuts.
Yeah. That doesn't even show up on the pie graph. So yeah, I think that those were my big questions. I think the next step is honestly just, I wanted to talk to the client. I brought up the idea. He was like, hold the boat here. Like, this sounds exactly what we're looking for, but I didn't want to start giving everything out and then being like, well, shoot, let me also get in touch with Brett.
Totally. That's what we're here for. By the way, we have a mastermind I'm going to invite you to, and anyone else who's listening to this, financial advisors, CPA, cryptocurrency experts, commercial real estate syndicators, clients learning about it for the first time. You can invite their client. It's every Friday at 10 a.m. PST. I have past clients on. We have new people who are considering this, and it's called DST University. We show up in a Zoom room. We talk about the deal close story of the week. We talk about an exit of crypto or business or real estate into the DST, investing, strategy, frequently asked questions, and we literally open it up for any questions. There's no bad questions. So, you can invite them to that on Friday. If you want to keep it confidential, get that too. Then let's just schedule a time. Go to capitalgainstaxsolutions.com and just click on apply for a consultation. Here's the key: $1 million net proceeds, $1 million gain. So I know yours is big enough, so yours totally qualifies, but that's our minimum. So as long as you have that, then you're good to go. So that's it. Any other questions, Daniel?
No, I think we're all good, man. Is there anything as far as next steps where I should tell the client, here's where we're at in the process, just to kind of get things moving in that direction?
Yeah. So, don't sign anything else, okay, until you meet with our team. We do the x-ray, we go through it, and we form the trust is ideal. Now, what if they had signed something or they need to sign it right away? That's fine. Just make sure the buyer doesn't remove all contingencies, because then it's too late, right? And so it's always better to pre-plan and get with us. It's human nature to be like, oh, I don't want to get with you until I really know for sure. No, because that's where you can go past the line. And we literally have people call us and be like, hey, they just removed contingencies, or I'm about to close. Can I still set it up? And we're like, no, it's too late. So no cost, no obligation. So you should get on a call. You should email me and the client, connect us all, and we'll set up a time to get on with the tax attorney. And then we'll jam for an hour and we'll go from there. So that would be the process. By the way, if someone wants to get in touch with you, Ryan, Daniel? Was Daniel Ryan, that is. I'm thinking about that. What's that new Jack Ryan? What's that show?
Oh, yeah.
Which, by the way, the guy from The Office is so much better than The Office. I watched like the first 3 episodes. I was like, this guy's not, Tom Clancy, like spy. Like he's whatever his face from The Office. Like we couldn't take it serious. I don't know what you thought.
Yeah, I haven't seen it, but I will always remember him as Jim from The Office. So for sure.
Yeah. But where could people find you, Dan, if they want to reach out to you?
They can contact me at ryanfinancialsolutions.com.
Cool. And you're a financial advisor out of the Portland, Oregon area, right?
Yeah, yeah, I own an RIA. I actually specialize in public servants here in the state of Oregon, but that usually brings the people who own small businesses, their spouse is the teacher or something. So,
There it is. Well, awesome. Well, everybody, I'm going to let everyone go now. Thank you so much for watching this. If you're watching on YouTube or listening to it on our podcast, if you want to connect with me, go to Capital Gains.